3 days of extreme volatility are about to happen, and all of us need to be worried about it. The Dow sees the first death cross since March of 2022. CPI inflation numbers are coming. And of course, Bank of America is now saying that maybe small caps are starting to look pretty good. Do we have the stats that back that up? We also need to talk about this orange line. Over the last 18 months, it's been pretty good at predicting market moves next. Will it continue to hold, and what exactly is it? We'll talk about that in today's video as we focus in on some of the biggest moves of the last couple of sessions. Tesla did exactly what we'd hoped with a big bull rally, one of the best of the last session, and the melt up continues on the S&P 500. Is this what the stats show usually happens after such a huge rally? Everybody's turning bearish, including the put options, but unfortunately there could be a melt up. US 2-year yields, this is the one that we need to be watching, and we know that the Federal Reserve is going to be paying a lot of attention. That and more coming up in today's show as we cover everything to do with stocks, commodities, and cryptos. Well, welcome back everybody to the Daily Show. We're looking at macro lead indicators and the hottest charts. If you like anything to do with markets, remember to subscribe and smash the like button. We've been doing this for over 3 years, and it's great to have you all here. So it was a mixture day. You can see Tesla really performed well. Healthcare also coming through with some nice green. But let's take a look at some of the stats before we go into the hard charts and look at why this market could continue to go up. That's the first one. Then we'll look at the bear side. First up, it's got to do with puts. Everyone's sentiment has turned into bull, according to what we're seeing on surveys. However, the reality is that everybody is buying puts. Put buying has really gone up to levels that we've seen in similar times where we've had melt-up rallies back in the start of 2023, and of course, the famous one during the 2020 crash. So as long as that maintains, we could be in a melt-up scenario. And as we can see here from Almanac, we can basically have a very similar period that we've seen after last time of 7, 8, and 9-day rallies. Common knowledge would be, well, we've got to have a pullback. And of course, we kind of expected that may happen around the trendline level. But now that we've broken out to the new high, we've been talking about this slow, methodical melt up that could occur over the next coming sessions, and why that actually is statistically the most likely thing to occur since the 1950s. Do you agree? Put your comments down below and let us know. Let's talk about call options versus puts on some of the major indices. One of those being the Russell 2000. A lot of people talking about this chart right now and saying there's too many calls on the Russell 2000. Well, maximum pain is coming for markets this week, and as we know with the OPEX, there's a lot to pay attention to. We shared this over on our Twitter X account, links in the description down below if you want to follow along and take a look at these charts. And here are the key levels to be watching this week. This is the Russell 2000. So while there are a lot of calls open, don't get me wrong, when we're talking about this week's options expiration, it actually shows that maximum pain is sitting at 170, which I posted, but really it's the 175 trigger that could be most interesting. And actually the Russell 2000 kind of looks like it could be setting up for a little bit more of a bullish move on the smaller timeframes. Here are some of the big levels. 175 obviously stacked with both calls and puts, kind of giving it a key level. We've also got the 170, which is maximum pain. And then of course we've got the 180, which probably will keep the bulls from going any higher than that this week. You might ask about the S&P, and of course, this is the one we usually look at with trillions of dollars of options expiration. 430 is the maximum pain, and just also so happens to be where most of the puts are sitting. So it's going to be hard for the markets to get really anywhere under 430 or 425 this week, and possibly difficult for them to move above 440. We're kind of trapped in that range. At least that's what the options market would have us believe. Let's move over to sentiment. As we mentioned, one of the biggest turns we've seen pretty much ever from bear sentiment into bull sentiment the next week. If this was true and we saw a ton of calls coming into the market, there'd be a good chance we'd actually see the markets come back down. But unfortunately for, of course, the bears, we've seen puts getting stacked day on day on day, which makes it difficult for the markets to sell off until they expire. Here are some interesting other things. Insiders, what are they doing in things such as utilities, a beaten down sector at this stage? Well, it turns out they're back down to not selling. So could this be a turning point for utilities? Also, is this like a prediction that maybe yields and yield highs are in? Well, of course, insiders believe so. And you can see here historically, when we do get these low reads and we start to see turns to the upside, that often is actually a pretty good period for that particular sector. The insiders generally know better than us, and according to corporate insider sales, utilities are down in the lows. Share of investors who say bullish about stock market right now, as we mentioned, this is just another way of representing that data. And you can see here what happened around that just lead into August period, which was a huge rally in bullish sentiment, followed by what happened after that, which was 3 poor months. Remember, when everyone's bullish, we need to be a little bit fearful. We're certainly seeing a big uptick in bulls, but it'll be interesting to see this week's survey to see whether that goes straight back down to bearish. Remember, the surveys are taken on Tuesday and Wednesday, and we only find out about them usually on Fridays, so they can be a little bit delayed. I will be on top of that though, and of course we'll all talk about it when it comes through. Let's also discuss whether we've seen a yield high. Have we seen the Fed actually go to a pivot point and therefore no new rate hikes? Well, of course, the CPI number is expected to come in lower than it was last time. Core, though, is really what the focus will be on. What's going on with shelter in particular has been a really sticky part of the economy and, of course, inflation story. But we do usually see the US 10-year lead. And the US 10-year actually did a change the other day where it broke to a new low and it's kind of hovering around that zone. Now, this is important because if the US 10-year continues to go down, firstly, it's showing that maybe a recession is coming. As you can see, when that does occur, generally these gray highlighted areas do end up causing a recession. But on top of that, it leads. So we're usually around the kind of point of maybe a 2 to 4 month lead period if we do see US 10-year come down from when the Fed actually does a rate cut. And that's the interesting component. Here are the trading days from a rate cut into a market low. Now, remember, the Fed is not going to rate cut out of the goodness of their heart. Generally, they're doing it because they broke something or they cooled the economy too much. And because when they do a hike, it lags behind, sometimes there can be really bad ramifications, which is why they're sitting right now. Here are the averages. Of course, 195 days on average to get the low period after the Fed rate hike has come through, or cut, sorry, in this case, and usually an average of 23.5% down. This is going to make for a very interesting 2024, although Goldman Sachs claims now that there's not going to be a rate cut until the end of 2024. Do you agree with them? I'm going to go with more than likely we get a rate cut earlier than Goldman. But hey, it's all guessing. We deal with the reality here on these markets and, of course, on the daily show. Russell 2000, have we seen a turn? Well, of course, Bank of America is claiming, yes, we have. And the markets are, of course, about to turn in terms of the next 12 months for the Russell 2000. They are getting absolutely brutalized. And when we've seen similar reads to this, we have sometimes seen the Russell go lower, but over a 12-month period, it actually has a 100% track record with being correct. Now, usually these stats you'd say, well, they don't have many reads. This one has quite a lot. You can see all the way back to the 80s, many different times we've seen this kind of play out. And it's an interesting one there for value hunters in some of the weakest stocks in the market at this stage. And as you can see, Bank of America, there were quite a lot of interesting calls. If you go back about a week and a half ago, we spoke about that whole taxation strategy that many of the larger players in the market uses, and they tend to do it during October to lock in capital losses. And of course, some of those candidates, or most of those candidates, if you look at them, have buy ratings on them by Bank of America, but at the same time, they're hugely underpriced to the buy rating themselves. Go back and check that out, subscribe, have a look if you're interested. Let's talk about gold. Now, we are kind of bullish here on gold over the next 3 to 6 months. We have been so since a reading we'll look at in a moment, but we're continuing to see inflows coming in from the biggest players, which is why I'm marking off here. And these inflows are really showing that pullbacks hopefully will be met by bull demand. Now, if we do get rate cuts, contrary to popular belief, that is actually going to be okay, I believe, for gold and possibly a bullish kind of sign for it. And we already marked out here since 1860, we've had a bullish read on gold. Now we're trading around 1930 something at this stage. Obviously, we've been over 2K and we're looking for a new all-time high. I've kind of said that over the next 2 to 3 years, I could see gold move towards 3K. And that's a pretty big call considering it really hasn't been able to move higher for a long time. It's a pretty manipulated metal. Silver, historically manipulated. JP Morgan obviously having a good story that you can read up on the internet about that back a little while ago and probably still to this day in some ways. Here are some excellent stats to do with the markets, and these ones, of course, will not make bears feel good, at least for the end of the year. And of course, every time can be different, but here is what happens or tends to happen when we have positive S&P 500. So the S&P 500 is up 15% for 2023. In the last 22 years in which the S&P 500 was up +5 for the calendar year on November 15th, the rest of the year, November 15th to December 31st, now note this, November 15th, which is pretty close, but not just quite yet, was positive. Going back 50 years, this setup was 27-3 with 3 fractional losses. So basically we have a 27-3 read that's pretty strong, enough notes to really show that this is fairly common to occur. And of course, the end of the year tends to bring the Christmas cheer. And we've already seen that happen usually in the back of November. So if we're going to see volatility, it's usually this week, which is the OPEX week, obviously Max Payne. Maybe next week as well after OPEX. We post usually a bit of a weakness in the pre-election year. So this is where we expect the volatility. And ideally near those last calendar days of the month, that's when we start to see the rally. So I could kind of see us melt up here a little bit, hopefully then sell off maybe next week even, and then rally back through. That would be a kind of good scenario. And we'll look at that on the charts very, very soon. In terms of unusual activity, I've got to say a big one on the dollar. Coming out of nowhere, dollar bullish fund. Now, I would say that's a sell personally based on the price action that we've been seeing, but some interesting trade here. You can kind of see when you look at it as an index bullish fund, it looks like a Wyckoff. We've kind of got that BC, we've got that potential UT over here. This is the real market versus, of course, the futures market, which looks a little bit differently. This is a concern because, of course, it's an island reversal towards the bull side. It's possible this is a buy. It is a dark pool transaction. It's right where it is. Now, if this breaks down to a new low, which we'll look at soon, it really marks a potential big turn for the dollar. And that's going to be huge for markets across the world. If the US dollar starts to weaken off, that's really going to tell us that the market's really predicting that we've seen that rate hike and that it's done and that we're going to start seeing cuts. Another one that's kind of countering with that is treasuries. We've seen some big moves coming through on treasuries. And of course, we now know that this area here was traded with one of the biggest transactions of really the decade. I'm stating a massive trade here came through with treasuries. So is it a buy? I would guess it is. But remember, with treasuries, they are position-based traders. Let's move over. It's not really about like where's their stop loss or anything like that. They don't have stop losses. They're adding or like kind of reducing their portfolio. That's usually the way they do things. When we go through here, we can see all of the different stocks that have been traded pretty heavily in the last kind of 24 hours. Notice that we're still getting some relatively large transactions going on in the Russell 2000. So some big stuff there, both in the puts and the calls. Puts actually outweighing the calls here again. And you can see also Exxon coming into focus, 1.37 with 148,000 calls to 19,000 puts. An interesting play there. LLY also coming in with unusual activity after the earnings of a few days ago. However, the options remained incredibly lethargic. Only 32.5, well under previous days. 48% puts, 52% calls. If you're a bear, you want them to start stacking calls everywhere. Calls, calls, calls. More calls, the better it is for you as a bear. Really showing that probably the retail trader has started to buy heavily into this market and that a turn could be coming on the charts. Then look for the price action. If the price action agrees with it, it's a great kind of 1-2 combo, and we always cover that here on the channel. In the last 24 hours, clean energy did well, solar did well, energy came out of nowhere. We saw some defensives start to come up, staples, healthcare. Utilities, though, right back down, negative 1.19%. It was kind of like a lethargic day, I would say. Like our strongest sectors, such as tech and semiconductors, took a breather, and it was more of a rotation into the others. Here's the last 5 days, so you can see kind of what's going on. Of course, the one we're really watching is home builders here and Dow Jones Transportation Average, which tends to still be pretty strong. And we'll look at that very, very soon as we go through these charts. Let's look at lead indicators now. First one, we have advanced decline. We did see a decline across the board in a bit of the stocks in the previous day trade session. If this continues and the market keeps rallying up, not a great sign. We certainly, of course, want it to go up. Puts continued to get stacked a little bit. So we can see here that even though calls were on the increase, the PCC was rising across all pairs, including the indices and stocks. And then if we go here to percentage of stocks above the 20, we're still sitting at about 57% in terms of those. Now, we mentioned at the start of today's video that we have here a bit of an interesting indicator, this line, this orange line. What is it? Well, it's the Bank of America high yield and basically effective index fund. And basically, this is the effective yield rate And what we're starting to see is, think of it as ways of like junk on junk is a good way of kind of considering it. And what we're looking for here is we're looking for a switch in this particular market. Should we be looking for a bearish movement? I'd be looking for this to continue to go up. So we'll follow this along over the next couple of weeks. Stay tuned to the channel, sub for it. And I'll show you how this line's interacting with price. Now, if we start to see price increasing and at the same time this orange line's going up, that is bad. As soon as we see turns on the market on the smaller timeframes, it's more than likely we are going to get a relatively significant sell. Now, if this starts to drop off and we're melting up, that's a great sign for the bulls. And you can see some of the interaction with this particular line over time. So if you have a look and you think about how the market's interacted with it, we're going to go up to a higher time frame just so we can see the weekly here. And what you'll notice is that when we saw this huge increase here in this effective yield, we saw that massive dump off of the markets. Once that started dropping off, which happened right here in the October lows, and of course, most notably also in June, which were our two bottom periods, then we started to see a real recovery in the markets. Recently, this has actually increased up, and then it's dropped back off with this rally. So if this goes up again and the market's still rallying, that is certainly a cause for question mark concerns, and we'll be looking at that relationship. So stay tuned for that. Let's move over now to some other sectors. Of course, VIX is expected to spike a bit. I don't trade the VIX, but we do use it as a fear or greed kind of sign. We're back to 15, which I would say is just kind of like a standard level. So not too much going on there. The volatility of the volatility, the VVIX, which a lot of people now look at, or VIX 1D is also another one you can be looking at. That is not increasing. We also have MOVE, which usually is something we look at, which is the bond volatility. That increased a little bit, but still quite low in comparison to where it's been during other periods in time. So if this does start to increase again, that is also a worry for markets and something we'll be looking at. Speaking of US 10-year, this is one to watch over the next 24 hours, along with the US 2-year. Watch this green box. If we end up getting an alert past 5.15, I think that's pretty negative for markets. Again, a sign that bears could be just on the horizon, especially if markets keep pushing up, and that's occurring. We don't want to see higher yields. The market will not like that, and obviously it will belt things like the Russell 2000. The caps will get hit. Treasuries will also get hit on that if that does occur, although treasuries have been putting in some great signs. Number one biggest transaction. I think there was number two biggest transaction around here. Huge volumes coming through. Obviously a lot of issuances, which people are saying, well, that's going to keep it down. And I don't doubt it. Could be a while for it to really rally hard. But as we know, the stats that we've been putting in the show, check our weekend video, show us that usually treasury yields actually drop over this month of November. And if that's happening, the yields drop, we often see an appreciation of the overall TLT. Let's move over to LQD. This is corporates. How are corporates faring? Pretty well. They've improved in recent weeks, and that's been a strong sign for the markets. Same kind of thing on high yields. We want to make sure high yields and corporates are both improving. We also see RSP kind of holding its own above the trend line. If that breaks out above 143.50, that's a really good sign that we're probably going to a new high for markets, and things are actually starting to really recover. And that's when the small caps will do much better in the mid caps in the markets. Liquidity feeds, whether the Fed is injecting or the central banks are injecting, that is the question. At this stage, they kind of just held it firm. We'll have a look after the CPI number, which is coming up very soon, and retail sales. If that shows injection after that, again, could be a bullish sign for continuation in the markets. Dow Jones Transportation Average, what's going on here? Sitting, holding, not necessarily a bearish sign, just kind of either accumulating or distributing. At this case, you would have to think it's probably accumulation based on the fact that the market has had that big V shape. If it drops off, obviously a cause for concern. But for now, if you break to a new high, set alerts both sides, worthwhile doing. Home builders, same thing. If this breaks to the upside, really strong for the markets. If it breaks to the downside, we're looking for a pullback and down to some levels we'll look at very soon. Copper, iron ore, both improved, not too bad. Obviously something we expect. Commodities, I think they're in a multi-year boom at this stage. And although you might look at it, check out iron ore. You'll notice that iron ore has been doing pretty strong numbers recently. And I think that's due to a bit of China stim in the back, and also just in general, building construction starting to see a bit of government funding coming through. At least that's supporting it, in my opinion. Dollar index is weakening here. However, we're not underneath that 105.24. Huge transaction going through. Certainly a question mark for shorters, for people that were looking for really quick shorts. You would have loved the price action of the last 24 hours. This is an excellent short level. Very strong zone for you to be looking at. And of course, where we would expect weakness to come back in, and it did. And that weakness in the dollar pushed into gold, with gold making new low, tapping into our box, not quite got to 1931, not getting to 1920, which would have been a sweet level. Although I've noticed everyone has that zone now, which is always a concern. But actually, gold putting in a change. So gold showing us that the bulls are possibly back on the small time frames. While the 2 hour remains down, lower lows, lower highs, lower lows, lower highs, the 15-minute chart, the 5-minute chart, the 10-minute chart, all these charts actually showing that gold has a little bit to push. Possibilities here of dollar weakness into like a 1960 gold. It's going to come down to CPI. Obviously, that's going to break or make this trade. But initial signs showing like pullbacks into longs could be the strength here for gold. CPI will move it though. That's the thing. US oil, really nice trade on this one. I talked about it in a Monday open show. And I mentioned that, I liked what I saw with oil and I was kind of bullish on it. Oil to 80, just under 80, 79.50 a barrel. This kind of supply here is the first stop for it. I could see oil even moving to 81.50. Now, we've been really negative on oil, but the thing about oil was it was super negative and then it started to make some structural change. It's also really far away from the 20 moving average, which you can see was really respected here on the way down. So I'd like to see it back at 81.50 really, or 80. Somewhere in this kind of supply would be best for oil. That would be a nice little pickup. Tesla, fortune favors the brave on this one. If you were brave enough on Friday, congratulations, smiley face for you. Nice rally here, 4.22%. Post-market up another 0.7. Tesla really rallying, an excellent little trade here for the day traders. And if it breaches through this high, you might be looking at a gap fill to 240. So Tesla, the signs at this stage, as long as the market holds up, are bullish. And of course, I'm sure the bulls are feeling pretty good about that. Regional banks in general, a lot of people mentioning, some are up, some are down this year. JP Morgan's, of course, really pulling across the crowd. We will be watching how these react over the CPI numbers. And more importantly, whether there are buyers between $40 and $41 for the regional banks. And of course, the financials, which is XLF, that's still holding pretty strong up here. I'd like to see it kind of do this really, but only a pullback in the market's clearly going to get that back down. Let's move over to some other things. Let's go to indices. Australian market first, holding its best it can, kind of giving you 2 pins here. That's relatively strong, although if the market does get underneath 69.50, I could see it really getting hit pretty hard. That's something that's a bit worrying. If you were looking at it on the surface, you would say, all buyers are here pretty strongly. And if we do see a rally break, we're probably going to get through 7,100 and push into that 72.50 supply zone. So at this stage, the Aussie market's looking okay. The Chinese market, fairly strong, but still not through our 38. So it's just kind of basing, looking for a nice explosive move there. I really want to see some momentum in that market. Now, we mentioned the Russell 2000 before. What's going on with the Russell? Well, as we said in the Monday stream, I really liked the Russell for a little bit of bullish action. Now, I think at the Monday open, we were talking about it kind of in here. Then it came back down. It's actually an excellent entry for buyers. And if you were lucky enough to get involved with that, I think an excellent little TP in this supply here would have been good. Got the drop, base drop. You've obviously got a clear supply here at 1710. I still kind of favor this as a little bit of bullishness based on the structure we saw on the small time frames. But again, it's going to come down to CPI, and that's the problem. You don't really, other than TA, which is obviously just more of a zone setup, and our opinion doesn't matter about what CPI is going to do. We're just looking at the structure that's setting. The CPI can come for liquidity grabs. So that's going to be a big issue. The liquidity grabs. What is the CPI? Is it going to go boom, boom like this? I always say that after CPI, you're better having patience leading into the event than react to the number after you've seen the trap. And if you can find a trap, that's usually the better way of trading. We cover it in our day trading masterclass. If you're ever interested in finding out more about how to take advantage of news, but not trade before the news to get your ass kicked. You want to trade after, where you can react and you can see Wall Street position in, or composite man is in what I would call it, position into some type of liquidity. And that's usually the best or the better way. If you agree with that, again, post in the comments, let us know. Qs, strong breaks, obviously coming into previous resistances around that 380. Very strong movement at this stage on the Qs, that high gamma play really coming through. We're at a fairly critical resistance. You can see here that weekly kind of high level over here. And then, of course, we've got 15,750 as well. I'm not really looking at the Qs, though. I've got the Russell in mind, and I've got the S&P 500 in mind. New high, gap fill done. Okay, well done there. Obviously, many gaps to be filled on the low. So we've got gap here, we've got a gap here. We'll post those into the next video. And even we've got gaps down here, which a lot of you want filled. So, something like this would be pretty sweet if that was to occur. I kind of think, though, at this stage, we might see a rally up. Maybe we hit like something like this, then 45.10, 45.12, then maybe something like that. That would actually be a pretty sweet trade for the rest of November into December. Let's find out whether it does occur. Melting up slowly here on futures. Mark out levels 43.37, 39 as the low close. If that does occur, we're more than likely going to see us push into this green box down here. That could be where people find their buy pressure. And at this stage, of course, the stats show that we usually melt up 45.12 to 45 kind of 30 in focus for the next resistance zone. And I could see us melting up, even though that might not be what a lot of people like to see. Let's have a look at crypto. Bit of selling, although it is still a dull market. So what that means is that we're slowly clenching it. This is kind of like what the S&P might look like soon. You don't really want to short into a dull market. It's still dull. There's no signs of significant turn yet in Bitcoin and Ethereum. The main sign or main weakness that you're really seeing is got nothing to do with Bitcoin. It's actually Ethereum, just because Ethereum hit 2100. And if you look at that on a weekly, you'll see what I mean. That's just a critical zone. Previous highs, previous little bit of supply over here, and obviously a good TP zone for some Ethereum traders. But I think Bitcoin's in the middle of nowhere land. It could certainly go further up. As we mentioned, Max Payne will be in focus, and we'll keep going with that. But do remember, 8:30 a.m., we've got core CPI coming out New York time, and it's expected to be 0.3% core with a drop in CPI pretty much due to energy. Let's be real. If you think CPI is going to be up, it shouldn't be. It should be down. So 0.1 is the expectation. And then we move over to Wednesday, which is going to be PPI, retail sales. Retail sales expected to get quite weak here, 0.2% drop expectation. Will it be better than that and still a hot economy? We'll find out. And then, of course, we have some other bits of news for the week. But really, it's probably going to be the Tuesday, Wednesday, and Thursday. There'll be volatility. Thursday is usually volatility because of OPEX and the fact that we usually see a lot more trade on OPEX actually on the Thursday. And the Tuesday and the Wednesday are going to be economic news / manipulation of the trillions of dollars of options expiration. Check out the links in the description down below. If you're interested, we are launching a whole new beta newsletter, limited availability down there. We're just going to give it out to, it's completely free, by the way. But if you're interested, we're just going to give it out to a lot of people that are viewing here. And then, of course, we'll close it and then reopen it again in the future as we launch that. Check it out. I'll have more information on it in the next video. Thank you so much for watching. Please subscribe, smash that like button, guys, and we'll see you in the next one. Bye for now. And stay safe out there. Remember, patience, react, don't predict. That's the best case of action into something like the CPI numbers. Bye for now.